Welcome to TheoTrade. This is Don Kaufman. February 11th, 2022. There's 10 minutes to go to the cash close here on this Friday afternoon. Doing the weekend update here. How to profit from inflation and absolute Fed disarray. Obviously, the topic of inflation is pretty much over and done with, of course, until you recognize that the FOMC is going to have a closed-door meeting on Monday. We're going to discuss that here in just a moment. But first and foremost, again, with just minutes left to play inside of this trading week, S&P is getting hit hard to the tune of 1.75%. The Nasdaq getting slammed by the tune of about 3%. Let's start this weekend's update here. Well, again, the market's still open, but let's start the weekend update with a little bit of a market kind of in review, because there's a few absolutely critical aspects to understand that have transpired literally yesterday when the CPI report came out. Again, inflation, it's over and done with. We're all relatively aware that inflation is out of control at this point with a 7.5% print on CPI. Nevertheless, the impact to the markets, and looking at this from a much more quantitative point of view, let's get to it. A little bit of a market update here. First of all, inside of the S&Ps, right? Still open. They're rocking right now. One thing I love to look at is volume in a day like this. We're doing 2.1 million contracts. For those of you who do not necessarily speak geek, yeah, you've got some elevated volume. The one thing, though, to be pointing out about volume, this is not what capitulation feels like. Keep that in mind over the next couple of days, because the next thing I'm going to talk about is absolutely critical. Like the day, it looks ugly, right? So S&Ps have been down as much as just about 100 handles. But what I really want to point out, probably first and foremost, is that we're now back inside of what we term the volatility box, aka the hurt locker. For those of you that have absolutely no idea what I'm talking about on this particular front, the volatility box is something that arose, and they will continually arise from time to time inside of the marketplace. But here is the present volatility box, and dropping into that volatility box is, again, we are just in it literally by a hair at this point in time. Just to point out, maybe the upper edge of it is about 44.50. We dropped into it. And the moment we actually dropped into that volatility box, the marketplace got downright wild. Why? Why point this out? Because it starts to give us levels to which we can actually trade upon. The lower edge of this volatility box is right here. And to get very specific now, we're talking S&P futures language, right? It's 42.11. Okay, the absolute lowest print we saw recently was 42.12, but at 42.11, that is not by any stretch of the imagination a recent level. When I say it's not a recent level, people, look, you can back up for a considerable period of time. That's something I marked on my screen, okay, way back when. In fact, you start to open up even like a 3-year chart, you can see how significant this literally this 42.11 handle inside of the S&Ps happens to be, even when we do what we term a chart adjust or a futures adjusted chart. If you're unfamiliar with that terminology, again, you can actually click right here, come under futures, and you do adjust for contract changes, right? And it actually makes it a consistent contract, and you'll see it is absolutely pivotal level inside of the S&Ps is, again, 42.11. I've got substantially more levels, considerably lower than that. Nevertheless, okay, the one aspect to point out here and giving you this update is once you start to drop back into this volatility channel, all right, it literally becomes Mr. Toad's Wild Ride. All bets are effectively off and things can get downright hostile. But here's the key, and we're going to talk about this, like how to actually profit from a little bit of that disarray, how to profit from, a wild marketplace. I'm going to tell you right now, has a lot to do with being able to sell options premium in the midst of it, because directional bias at this point can really, you can throw it out the window. We have no idea what's going to happen on Monday with the Fed meeting. The Fed meeting could be a surprise rate hike. We'll talk about that here again momentarily. But the one definitive aspect to begin with is once you drop into this volatility channel, it's like all bets are off. At that point, okay, it is so very on. And by on, I simply mean, listen, you could sell off 100, 150 S&P points, feel like we're going to drop into the abyss, explode back onto it. But it's not the volatility box inside of the S&Ps that kind of has me concerned. All right, the one that I'm really looking at here, and I'm going to use the exact same chart. This is a 30-day, 1-hour chart. The one that really has me concerned is right here inside of the Nasdaq. And the Nasdaq, okay, not only are we in the volatility channel, but we're right to the mid of the volatility channel. I'll come back to that in a few moments. All right, so in this kind of market update, so the market's got 3 minutes left to go. There's a little bit of a bid back under us, okay, but this marketplace downright volatile at this point in time. Next in the docket, volatility. You got to look at volatility for what it is. You got to look at volatility through and through. Volatility has gone into effectively quite the serious situation. Now, if you're looking at volatility futures, well, you're looking at the wrong volatility futures. You do not want to be looking at Feb volatility futures. You want to start looking at March volatility futures, and March volatility futures versus, of course, April volatility futures. And when I start discussing aspects like, if you will, backwardation, what do I mean? Short-term volatility, okay, is now above any of the longer-term volatility. So volatility, if you were to actually plot this, looks effectively like this. In fact, you can, in fact, plot this on the thinkorswim platform. It's actually called a depth chart. You actually come into charts, come into product depth. All right. What you're actually looking at is present volatility versus, well, another curve in here. I didn't plan to pull this up over here, but I'll knock out the other curve. I say knock out the other curve, and then we're actually going to get rid of a few different expirations in here. But if you're kind of curious what volatility presently looks like, okay, in the very near term, it's like this. And you go, when it's like this, you're looking at March and then April, and then, you know, of course, out to the June expiration. You go, why does it look like that? Well, all this is a chart of, all that is a chart of, okay, is again, the March, the April, and, you know, jumps all the way out to like, you know, the May, June time frame. And what it's plotting is that risk. Okay, risk in the here and now is considerably higher than risk in the future, which means, you know, the world's blowing up. We're on fire right now. And you have to be able to read into that when we actually get inverted. And again, this is actually a serious, what we term backwardation, a very serious backwardation. With that, you know, and you can couple that, if you take a look at the VIX. The VIX, yeah, it had a decent spike up, and it's actually got a little lackluster here in today's close, but the VIX did get rocking, got rocking over the 30 level. But time out for just a second. If you want to see the VIX really explode, okay, and today, again, there was fear and loathing inside of the marketplace, and you think that this is a VIX explosion, I'm going to tell you right now, it's absolutely nothing. Okay, it's nothing. The next time the VIX is really going to rocket, we got to get all the way down to the 4,200 level. You start crossing through 4,200 in the S&Ps, and the volatility is just absolutely going to come apart at the seams. You need to know that. That's in this market update. There's some forward-looking statements you need to know that if you're going to go out there and you're going to trade in this marketplace, I don't care whether you're buying premium, whether you're selling premium, okay, whether you're just long or short stocks, if you're not aware, the next time the VIX is really going to rock, we are going to have to get, okay, to 4,200 or under on the S&Ps, because at that point, we're going to get downright trigger happy. Okay, that is when, again, listen, the market has seen big moves before. Oh, I'm scared. Like the VIX, it definitely lifted. But at this point, once the VIX is actually lifted and we've gone into backwardation, like all bets are off at that point. And that's the big takeaway over here. Looking down towards the bottom of the screen, the VVIX, the volatility index, anybody seems to be hedging today. Again, the VVIX all the way back up into the 140 handle. And of course, if you look at the chart here and you're like, well, the VVIX was all the way up here at 172. Yeah, no kidding. Because the last time the VVIX was up at 172, we were trading right down here at 4,200. Remember, the market's always like watching a scary movie. You saw a scary movie one time and we traded down to 4,200. Now we're into the second time we're going to see the scary movie. And you know what? It's not as scary the second time. Till, of course, there's a new monster. And the new monster takes us below 4,200. Got to keep this stuff in mind. There's the closing bell. All right, not a second too late. S&P is just getting slammed down a full 2%. Nasdaq off by 3%. All right, with that, again, couple of other really key aspects in here. So you know volatility is bid. Okay, you know that both the S&Ps and Nasdaq, are back into this wild volatility channel. I'll talk more about that here in just a moment. Okay, here's one of the most wild things that's actually occurred today, and that's one of the primary reasons I wanted to do this update. The bonds. Now, this is like one of the more confusing aspects to people. The bonds. Earlier today, they're down. They hit the 150 and then just downright exploded off the lows of the trading session. Do you realize how large of a reversion back up we've actually seen. 150 and 26 ticks. There's 32 ticks to a 1-point move, right? So basically, we're trading just below 151. Just below 151. We traded 153 at the close, okay? You've got plus beyond a 2-point move, all right? So what do we say about this? It's just huge by huge. If you look at this trade, okay, this is very counterintuitive. Why is it so counterintuitive? You look at this, you go, it doesn't make sense. Everybody's worried about inflation. Interest rates should go up, right? Interest rates should go up until, of course, you look at the TNX. Come on, take a look at the TNX. Interest rates actually cracked over 2% and actually closed the day under 2%. How could it be, all right? Because what you're looking at right now, this is true. This is true real fear. Fear and loathing inside of the marketplace. Buy, okay? Whatever you possibly can, whatever makes sense that is not S&Ps. You want nothing in the S&Ps. Look around the marketplace. They're smashing everything except, of course, energy, right? They're smashing everything. And I don't want to sit here and start to comment about geopolitical risk, right? We're going to look at oil here momentarily, but it's neither here nor there. Okay, there's geopolitical risk. Got it. Check that box. The key to this is not the geopolitical risk. The key is the fact that, when you get real fear in the marketplace, they'll turn around and buy an asset class that doesn't even make sense at that point in time. But it's a duck and cover position for huge capital. Huge capital cannot move into cash. There is no cash for huge capital. So you've got to actually, if you're, moving billions of dollars, you got to move into some asset class. What asset class do they move into? Bonds. Look at the volume in bonds. Okay, the volume in bonds is almost catastrophic. Okay, the irony is the volume in bonds is almost as large, well, it is today, as it was obviously the previous day when the CPI report came out, which was also huge. All right, if you take a look at the notes are trading almost record volume. In fact, take a look at this. You got to open up literally a 3-year chart. Okay, now there's some contract rolls in here, but this 3-year chart, there are very few instances, okay, on a 3-year chart that you see notes actually trade this much size by size, people. The other aspect, talking about fear inside of the marketplace, the dollar. The dollar, it's not a massive bid, but again, the dollar did the exact same thing that you saw inside of the bonds, right? Where all of a sudden they're like, that's it, we have had it, okay? Everybody rushes into the dollar. There is real fear now, again, starting to hit the market. That's why I wanted to give you that quick update. Now, forward-looking statements. There is a Monday Fed meeting. There is a Monday Fed meeting. It's a closed-door meeting. This is not going to have a press conference, yada, yada, yada. You may hear nothing about it unless, of course, there is what we term a surprise rate hike. That's the talk of the town right now. It's all rumors. It's all conjecture at this point in time. But if they do come out with that rate hike, okay, and it is surprise, we're going to move 50 basis points. We are not even going to wait for an FOMC meeting in March. You have to understand the contradiction over here. We haven't even, finished tapering off some of the bond purchases. So with one hand, they're literally like, we're still buying with one hand. And the other hand, they're like, raise rates. Listen, okay, it's neither here nor there. Inflation at this point really is. It's absolutely rocking to the upside. The Fed's going to step in, but they may step in a little harsh at this point. In doing so, they can completely stall out the economy. And everybody wants to argue where inflation is coming from. It's supply chain. It's this. Listen, it's the Fed. It's fiscal policy and monetary policy. Always has been, always will be. Supply chain constraints are just kicking it in there a little bit harder. But raising interest rates at this point, you're going to be behind the curve. Inflation's going to be here to stay. And I think that you have to, remind yourself of that. So anything that the Fed does, and the reason I'm saying that, and I'm, going out on a little limb here and making some pretty strong statements, like whatever you might think about inflation, okay, here's the bottom line. The Fed is going to continually be behind the curve at this point. And knowing that, when I say behind the curve, listen, we already had a 7.5% CPI, cat's out of the bag. Anything that they do is probably going to overshoot and stall the economy in the near term, which is going to be negative implications for the S&Ps. I think you should keep that in mind. Tech is not going to look good. All right, so Monday, that particular Fed meeting, there's one easy way to read into the Fed meeting. Okay, what's the easy way to read into the Fed meeting? All right, we have no idea what's going to happen on Monday. None whatsoever. But if you look at the February 14th, it's Valentine's Day. I found love in the S&P. All right, but the one key is inside of that meeting. Okay, is right here. By the way, you think Jerome Powell is going to bring a date? I'm just kidding with that one. Here we go. It's a $77 expected move. So put on your big boy pants because Monday is going to be rocking, right? Part of this could be geopolitical risk because of Russia, Ukraine, but part of this is definitely an FOMC meeting. You're also looking at roughly almost $140 expected move coming into next week. So again, all of the above is occurring here. Next thing, Nasdaq. We got to come back to the Nasdaq because I can't stress this enough. The Nasdaq. We have some serious risk at the table right now. The serious risk at this point, and again, I'm just going to pull up that 30-day 1-hour chart. The reason being, crossing under 14,000 inside of the Nasdaq, we got absolutely trigger happy the last time that happened, and it was complete and utter chaos. I cannot stress this particular level enough. 14,000 inside of the Nasdaq. It couldn't be a more clean level. All right, we can sit here and we can discuss it till we're pretty much blue in the face, but the reality is, all right, you can actually pull back again a more significant time frame in here, and again take a look at that 14,000 level of how significant it is. And again, it's so rare that we get not just a level, but a level that is spot on. I mean, just absolutely spot on. And take a look. Like, this is a level, people, that is going to resonate. Under 14,000, we got downright wild the last time through. Okay, I am very, very cautious right now inside of NASDAQ, simply because this is the type of marketplace you can come an absolute bottomless pit. If we cruise over to the QQQ on a year-to-date basis, you can already see it's down by about 13%. And, well, that's going to bring up the next point. Because the QQQ is down 13%, a drop, and a precipitous drop, actually can shoot us down 20%. We could start calling this a bear market here in a very, very near term inside of the Qs. In fact, to measure, real what we term bear market status, you would go from recent high, of course, to present, and you're down about 14%. It's not going to be too much further here. Again, taking us down into the, if you would, just about the 325 level in the QQQ, we're officially bear market status. People, we're close to it. We're very, very close to it at this point in time, so that's going to make some big headlines. So again, we become an absolute free-for-all in this marketplace, but at the exact same time I'm saying this, you need to look towards the financials. The financials, they've been unencumbered, unhit. I mean, they have done spectacularly, but look at the price action of the financials over the last 2 days. They got smacked, and I'm going to tell you right now, coming into next week, if this marketplace is going to continue to get hit, they're going to hit the hardest what has been outperforming, and right now it is the financials. Now, of course, you're going to tell me, no, the energy sector is even outperforming that. I would agree with you, but the energy sector at this point is caught up in geopolitical never land. All right, because we have oil now up literally 23-24%. Oil, by the way, is also in a full-fledged backwardation. If you're unfamiliar with that, short-term oil is way above longer-term oil. Like, we're all the way at $94 in the 11-day oil. Go a little further out in time, you've got like $84 oil, and even less further out in time. Oil inside of again, backwardation screams geopolitical risk, but the point to assume out of oil, forget about the geopolitical risk again for a second. The point to actually take from oil, we have the perfect storm right now, right? You've got bonds that went bid. We have S&P selling off bonds that went bid. We have volatility futures and backwardation. Oil, crises happen in markets when oil is exploding higher. And there's something I've reiterated time again. If you look back considerably, I mean, you know what? Let's just show you the full Monty here. Every major spike in oil, and you can go all the way back into the internet crisis times, back here in like 2000, 2001, oil absolutely ripping to the upside, oil ripping to the upside just before the financial crisis, oil ripping to the upside in 2011 before the marketplace tanked, and oil once again reaching for the stars over here. You got to be careful, because all that is just another nail in the coffin for the S&Ps at this point. Again, I wanted to be as forward-looking as possible with that. Now, how are you going to profit from some of this? So the S&Ps are absolutely getting slammed because we're in a volatility channel, because we're in a volatility box, right? It ain't going to be easy, meaning that there's no directional, individual, there's no timing this. We could absolutely explode to the upside right back to 4,500 before actually hitting 4,200. Volatility is excellent at making you do the right thing at exactly the wrong time. What I strongly urge you to do, Okay, at this point in time, you got to learn some premium selling tactics. Stuff as easy as, again, we talk extensively here at TheoTrade about Ultima. Okay, and there's actually what we call a come out strategy that I've been using extensively. And that come out strategy, when I say a come out strategy, like, I don't know what that means. It's a strategy to actually come out and start selling premium. All right. And when I say, a come out strategy, we're going to go just a little about 30 days out into the future here. We're going to open up all the strikes and just want to make a very, very brief point, okay, of the kinds of trades that we're actually able to employ. And again, you can actually employ these rather, okay, with limited capital, because I'm going to show you a trade right now that's going to look like it has amazing amounts of risk in it, but it really doesn't. So I'm going to buy a 424 put. I'm actually going to sell a 414 put. Now this is actually done for about $1.90 debit. It's about 30 days out. Then consequently with Ultima, we go out more time, higher skew. Okay, if you don't know what that means, more time means higher skew. We can actually cruise over here and look at implied volatility. The implied volatility and the skew, okay, the impact of that skew right now isn't negligible. You go out here about a 6 delta. Look at this. We're actually selling like a 40 vol. So 98 days out, we only have about a 29 vol, but you're actually selling a 40 vol in this particular case. Take a look at the trade. Okay, so what we're doing is we're buying a put spread. Okay, we're buying a put spread and then turning around and financing it at the sale of a naked put. You go, that is insane amounts of risk. Really, it's actually not. And then everybody talks about, what about the margin? What about the margin? How about if we could actually make that margin rather negligible? And again, I didn't necessarily plan to pull up the trade over here. So what I'm going to do is I'm going to come in here and I'm going to hide all of my present positions. Okay, you're just going to look at my simulated trade. So I just built a quick and dirty simulated trade. And I want to show you. Okay, I want to show you exactly what this looks like from a risk point of view. And again, a risk point of view. So this particular trade collects a decent credit. Now, I'm only showing you a one lot of it, right? Okay, if the market outright crashes, the reason we actually call this is actually an inflection point spread. If the market actually crashes, you have to hit the inflection point before actually going over the falls. And you can actually sell quite a bit of premium using this particular tactic. But then you go, the hedge is only good for a short amount of time, but that's actually okay. If we rally up, right, you can actually close the entire position profitably. We sell off huge, all right? There is, again, many different variations of what we term this inflection point spread. So everybody, of course, then looks and they go, the margin of this is going to be terrible. Of course it is. Selling naked options has terrible margin, unless, of course, you use options on futures contracts. And options on futures contracts have negligible margin. Most people are also not aware that, did you know that you could actually trade options and futures inside of an IRA account? Over here at Tastyworks, okay, I've actually got a multitude of different positions on, okay, tying up. And again, this, I want to make very, very clear. Not only am I actually using a couple of naked option premiums with a hedge in here, but this is also inside of an IRA. My entire margin in the IRA is $6,500. In a standard Regulation T margin account, it would actually be half that, which is like $3,250 in terms of margin. But don't ever tell me you can't do anything in your IRA, because this is a full-blown what we term Christmas tree spread, a 1 by 3 by 4 by 5, which is actually like an inflection point spread, like on steroids. But when you guys, I'm telling you right now, okay, markets could crash and absolutely get crushed at this point in time, and we would be, for the most part, unimpeded. And again, I'll even show you some of my live positions in here. And I like to always explain, whether you have positions on. So I've got live positions in here. This is what a good day should look like for a premium seller. I'm taking a couple of short positions as well, but this is, the full Monty here. This one's up about 14,000. And actually, to aggregate even more accounts in here, I have both an IRA and a standard account in here. It's up about 18,000. We take a look, of course, over here at Tastyworks, also up a pretty significant day. And this has a lot to do. It's, when you talk about like how to profit from ultimately inflation, market volatility, and Fed disarray, you're going to sell premium right now. If you want to survive this marketplace, you're going to sell premium, because trying to pick a bottom over here is going to be futility, just futility at this point in time. And again, I do want to show you a little bit in the Analyze tab, one of the last things to leave you with here. If we go to the spiders, I'm going to hide all simulations. I'm going to show you, okay, what positions and what positioning looks like. This is a very, very small account. This is a small account that we actually share with clientele. Okay, but to look at the P&L graph, again, to look at the P&L graph over here, I want you to see profitability in this particular context. First of all, it's jumping all over the place. Okay, we're jumping all over the place. Do we have downside risk? Yes. If the S&Ps are to get under the 400 level, which is possible, it's plausible, okay, but we can, of course, reduce risk. Anything to the upside, though, is going to be profitable. And again, to get even more specific, to actually show you the kinds of strategies that we're using right now, here, okay, is our Christmas tree spread. And the Christmas tree spread right now, to be quite frank with you, we are here. And again, I want to see and show you we are here. Any movement to the downside would actually be wildly profitable. This is a 1 unit trade that can actually produce, and again, I'm just going to drag the mouse on the screen, this can produce as much as almost $7,000 of P&L with sell side activity in the marketplace. Again, rather minimal margin, and I stress that to you. Listen, that's what Ultima is. This is Volatility Tactics, and it's the way to trade in this particular environment. When you feel like you have no directional biases and you feel like long stock, you want to be a stock picker right now with the Fed on the dance floor of raising 50 basis points, okay, raising in an emergency meeting, okay, being long, okay, is not about timing this marketplace. There is no timing volatility. Last but definitely not least, the SPX. Let's cruise over to the SPX, take a look at the expected move. Okay, the marketplace, behold. All right, this is some of the more wild moves that we've seen recently. This last week, we had a $107 move. That's a $107 move to the upside or a $107 move to the downside, right? So that's what we were expecting. We almost hit the upside of the edge of the expected move. That was Wednesday, okay? On Thursday, we actually promoted a little bit to the upside. We came, okay, within basically 5 S&P points of hitting the lower edge of the expected move today. But the key to this, it's not looking like, oh, this is where we were. It's to look forward. When I say to look forward, now we're actually going to see where is the expected move, okay, for the next week of trade. Where is the expected move? The SPX, all right? We're going to cruise over here. It's $135, okay? And what we're going to do, all right, with that information, I say it's $135. We're literally going to draw a line effectively where we closed, okay? Then we're going to go basically $135 higher, $135 lower. It's actually going to give you your expected move for this this next week of trade. So we are looking at about $135 expected move, which is, again, you know, how else do you say it? Put on your big boy pants. We bought volatility, went into backwardation. We bought bonds, which is a sign of fear. Okay, we bought oil from geopolitical risk. Everywhere you look in this marketplace, we bought dollar, which is ultimately duck and cover over here. We saw an expansion of expected move to 135. People, there's going to be a lot of risk in this next week of trade. Act accordingly. Thanks everybody for joining us here at TheoTrade. Have a wonderful Super Bowl weekend. Bye-bye.